end of financial year is just around the corner. In this video, I'm sharing 10 last-minute tips you can still action to save tax, cut costs, and wrap up FY25 in the best way possible. Let's get started. Tip number 1, review your investment portfolio and consider any planned sales. If you're thinking about selling shares, investment properties, or other investments, now is the time to weigh up whether it's smarter to sell before 30th of June or wait until the new financial year. If you have assets that have performed poorly and no longer suit your goals, it might make sense to sell them and realize a capital loss before 30th of June. These losses can be used to offset capital gains made during the year, reducing your taxable income, and they could also free up money to reinvest in better opportunities. On the flip side, if you're planning to sell investments at a profit, delaying the sale until after 30th of June means the capital gains will be included in the next financial year's tax return, giving you an extra year until the tax is due. It's also important to consider your marginal tax rate and which tax saving strategies are actually available to you this financial year and next. If the amounts involved and the stakes are significant, it's worth consulting a professional to help you crunch the numbers and choose the most tax-effective option. Tip number 2, consider making last-minute deductions before the financial year ends. Some options include making a charitable donation, prepaying income protection premium if the policy is self-owned, prepaying interest on investment loans if your lender allows it, prepaying business expenses like rent, utilities, or insurance if you're self-employed, making purchases like equipment or tools, and immediately claiming the cost through the small business instant asset write-off if you are eligible small business owner. Paying for tax-deductible subscriptions, union fees, professional memberships, or work-related education courses. Making a personal deductible super contribution, and if eligible, using your unused concessional contribution caps from previous years. On the topic of tax-saving super strategies, I made a dedicated video that covers 5 ways to save tax in FY25. Be sure to check it out. It's important to remember, don't spend money just for the sake of tax deduction. A deduction only offsets a part of the cost, not the full amount. Also, prepaying expenses simply brings deduction forward. It usually just delays the tax, but it doesn't reduce it overall. However, if you're moving deductions from a year with a lower marginal tax rate to a year with a higher one, it does result in overall tax saving. Since we are on the topic of tax deductions, here's a quick bonus update. Just recently, the ATO increased the fixed rate working from home deduction from 67 cents to 70 cents per hour. This change applies retrospectively from 1st of July 2024, so it covers the current financial year and beyond. Tip number 3, 30th of June isn't always the real deadline. It marks the end of the financial year, but when it comes to super contributions, many large super funds have earlier cutoff times for contributions to be processed and counted for this financial year. At the time of filming, this year's cutoff times haven't been released yet, but to give you an idea, here are the key deadlines from 3 major industry funds last financial year. So if you're planning to make an end of financial year contribution, make sure to check your fund's deadline so you don't miss out. Tip number 4, don't ignore your total super balance on 30th of June 2025. Your total super balance on 30th of June 2025 can affect various super strategies in FY26. It needs to be below $500,000 for you to use carry forward unused concessional contribution caps in FY26. It needs to be below $300,000 for you to qualify for the work test exemption in FY26. It needs to be below $2 million for you to access the standard non-concessional contribution cap of $120,000 in FY26. It needs to be below $2 million for you to be eligible for the government co-contribution in FY26. The receiving spouse super balance needs to be below $2 million for the contributing spouse to claim the spouse contribution tax offset in FY26. So if you're planning to use any of these strategies in FY26, keep a close eye on your total super balance on 30th of June 2025. If you are close to or slightly over the relevant threshold, here are 2 things to consider. 1. Be cautious about making additional super contributions that could push you over the limit. 2nd, consider strategies to reduce your year-end balance, which includes withdrawing if you have met a conditional release or using the contribution splitting strategy. I've done a dedicated video on contribution splitting. Be sure to check it out if it's relevant to you. Tip number 5, be aware of the general transfer balance cap increase. From 1st of July 2025, the general transfer balance cap will increase from $1.9 million to $2 million. The general transfer balance cap limits how much super you can move from accumulation account into a tax-free retirement pension, commonly known as account-based pension. This is Australia's version of a tax haven, where pension payments, lump sum withdrawals, and even investment earnings are all completely tax-free. If you're about to start your first account-based pension, consider whether it's worth delaying until the next financial year, because you would be able to take full advantage of the higher cap. For those who have already started the pension or used part of their cap, the increase will still apply, but only partially due to proportional indexation. Of course, there are other factors to consider before making a decision like this, so make sure you do your own research or seek professional advice if needed. Tip number 6, don't overlook self-managed super fund contribution reserving strategy. If you have a self-managed super fund, this strategy lets you use next financial year's concessional contribution cap while still claiming a tax deduction this financial year. In other words, you can contribute an extra $30,000, claiming the tax deduction in FY25 and have it count toward your FY26 concessional contribution cap. It's important to note that this strategy can only be executed in June. I have explained it in detail in this video, so if you're interested, make sure to check it out. Tip number 7, don't get caught out by the private house insurance premium loading. From 1st of July 2025, anyone born before 1st of July 1994 will be over 31 years old. If you're in this age group and still don't have a private hospital cover, a 2% lifetime health cover loading will apply to your private hospital cover premium if you decide to take it out later. This loading will keep increasing by 2% at the start of each financial year until you take out cover, and it can build up to a maximum of 70%. If you're watching this before 1st of July, there is still time to get cover and avoid this next 2% increase. I also have a full video explaining how lifetime health cover loading works if you want to learn more. Tip number 8, know when your extras really reset. Around this time of year, sales are everywhere. Retailers, including optical stores, dental clinics, and allied health providers, often claim that your private health insurance extras benefit reset on 1st of July, urging you to use up the limits before they expire. However, it's important to know that most Australian health funds reset extras benefit on 1st of January, not 1st of July. This means that for many, there is no immediate rush to use up extras before the financial year ends. That said, some health funds do operate on a financial year basis, resetting their extras on 1st of July. If you are insured with one of these providers, now is an excellent time to take advantage of any remaining extras benefits before they reset. So check your policy to confirm when your extra benefits actually reset so you can make an informed decision. Tip number 9, end of financial year is prime time to review your private health insurance. This is when the best private health insurance deals come out, especially in June. This video was filmed before the latest offers are announced, but to give you an idea, last June, big names like Medibank, AHM, and Qantas offered deals like up to 12 weeks free, waived 2 and 6 months waiting periods on extras, gift cards, and Qantas points. So if you're thinking of switching, June is a perfect time to score a deal. Tip number 10, apply any lessons learned. We get to end the financial year every year, so now is a great time to reflect on what you have learned from past ones. Think about what went well, what you wish you'd done differently, and any mistakes you don't want to repeat. Feel free to share your reflections and tips in the comments below. We can all learn a lot from each other's experiences. Thanks for watching. I'll see you in the next one.